Hi everyone, this is a technical analysis on gold. Let's start with a fundamental overview first. After a brief consolidation in the first part of the week, gold eventually broke out into a new all-time high and surged by more than 3% in just a day. The precious metal has been the only game in town recently, as the uncertainty and risk of flows haven't even supported bonds, which generally rise during such times. But these are not normal times, because the market is fearing stagflation, which hasn't been seen for decades. This is an environment where you have lower growth and higher inflation. Gold thrives during such times. The problem is that long gold is now the most crowded trade, and such parabolic rallies can be wiped out fast if conditions change. In the bigger picture, gold remains in an uptrend, as real yields will likely continue to fall, as the Fed is not looking to hike anymore. The risks for the upside in the short term include another aggressive stock market sell off, a hawkish Fed, or positive news on the tariff side. Now, on the daily chart, we can see that after this brief consolidation, gold skyrocketed once again into new all-time highs. From a risk management perspective, the buyers will have a better risk reward setup around this major trend line to position for further upside. The sellers, on the other hand, will want to see the price breaking below the trend line and the 2,957 level to extend the drop into the 2,832 level next. On the 4-hour chart, we can see that we have this minor upward trend line defining the bullish momentum on this time frame. The buyers will likely lean on the trend line to keep pushing into new highs, while the sellers will look for a break lower to extend the pullback into the 3,195 level next. On the 1-hour chart, there's not much else we can add here, as the buyers will look for a bounce around the trend line, while the sellers will look for a break. These red lines define the average daily range for today. For the upcoming catalysts, today we get the latest US jobless claims figures. But as a reminder, the market is focused on tariff negotiations at the moment, so the data is not as market moving as it used to be in the past months. So we will likely need at least a new cycle high in the jobless claims data to trigger a notable reaction.